Hello YouTube. This is Samuel right here. Today we're going to talk about assets portfolio and the importance of it in your day-to-day life and why you should have one, why we should all have one. So I'm going to try to go ahead and explain it to you. So if you don't know what an asset portfolio is, basically is this circle right here, which represents your portfolio. So where you have your assets, your investments. So for example, you could have treasury bonds. You could have stocks, like it's shown here in the picture. You could have short-term investments and even other stuff. Like for this video, we're just gonna be using these types of investments, but it could be anything really. It could be bonds, it could be high-risk investments. Some people they do forex investing. Some people they do stocks in the US, stocks in Europe, or indexes, like ETFs, S&P 500, stuff like that. So it really depends on your style and your risk management. Like some people, they have a higher risk appetite versus some others that have a lower risk appetite. So like let's say 70% of their portfolio is treasury bonds with liquidity, and the other 30% is like stocks. Some of them, they do 90% of treasury bonds and then 10% of stocks. Some people they don't even do stocks at all because they're afraid of fluctuation. And is that fluctuation? I'm not sure if that's the right word, but they're afraid of volatility of the market, so they don't want to put their money at risk. So some people they do, let's say 25% crypto and the other 75% are at a certain thing. So it really comes down to that. But basically what the portfolio is this wallet or this circle that represents what you have in your, like the assets that you have that are generating money for you, passive income. Okay. So here I will show you a few examples of portfolios. So for this photo right here, we have, like I said, 50% of bonds, treasury bonds, which is a little safer. Not little, but like it's actually safer than the other options here. 20% is in stocks because there is the fluctuation. I forgot how it said. I don't know how it says exactly, but like 20% of it is in stocks, and then 30% in this image, just for example, it's on short-term investments. Okay, I don't know what it could be. Maybe it could be, I don't know, swing trading, or maybe startups investments or some other stuff. It could represent many other things. Okay. And as an investor, is important for you to know. For the first thing is, it's important for you to know your risk appetite and how much of a balance you will develop throughout your journey. Because some people, I think this portfolio management stuff is very personal for people, from everyone specifically. For example, I have a certain risk that I feel that is good for me versus someone else that maybe doesn't like that much risk. For example, I could have like 70% in stocks and then 30% in bonds. So that means I can risk more than some other people. There's some other guy, for example, that doesn't even like stocks and is going to do 90% at treasury bonds, for example. But you're making less money because the safer you want to get, the less money you're making. But that doesn't really matter. It really depends on your profile, which one you prefer. And I think the more you grow, financially speaking, and also your net worth and your safety net, whatever, the more you start to realize which one's better for you. Because I realized that so 3 years ago I had an opinion when it comes to portfolio. I had a more conservative portfolio, and then like 3 years later, because of all of the knowledge that I developed, I have a way different point of view and a way different opinion on a portfolio. So it really comes down to you, how much money you have. If you have more, maybe it could be different than someone else that has to have less. It really depends on your work and the amount of work. Like how much money can you make and can you generate a month with your current work and stuff like that. So it's very, very personal. Okay. But yeah, so there's the hybrid portfolio, which approach diversifies across asset classes. So building a hybrid portfolio requires taking positions in stocks as well as bonds, commodities, which is good as well, real estate, and even art. Generally, a hybrid portfolio entails relatively fixed proportion of stocks, bonds, and alternative investments. This is beneficial because historically, stocks, bonds, and alternatives have exhibited less than perfect correlations with one another. So Correlations is also a big factor when it comes to managing your portfolio. Okay, we're gonna cover that a little bit more, like deeper, more in depth. Sorry, in the next videos. So, like I said, there is the aggressive portfolio, the defensive portfolio, the income focused portfolio. So it really comes down to what you want to have. Okay, so for example, aggressive equities focused portfolios. So the underlying assets in an aggressive portfolio generally would assume great risks in search of great returns. Aggressive investors seek out companies that are in the early stages of their growth and have a unique value proposition. Most of them are not yet common household names. So, for example, startup companies, okay? Companies that have a very strong promise about the future. I don't know, companies like AI companies, because we all know that AI is almost like taking over the world. Let's put it that way. It's really good, like that. For example, like the AI thing is gonna grow. I think it's gonna grow for the next 10 years so much. And some people, they would invest in companies like that. For example, it's just an example, AI, but it could be anything really. You know, something that's gonna revolutionize the world or stuff like that. But it's very aggressive, so the risk of losing all of your money is greater, you know, than if you had a conservative portfolio. But at the same time, is if you make money from it, then you're gonna make so much more money than someone that is investing in a conservative portfolio. Okay, but it really comes down to the amount of money that you have right now. Of course, everything is proportional to your net worth that you currently own. So defensive equities focused portfolio. So a portfolio that is defensive would tend to focus on consumer staples that are impervious to downturns. Defensive stocks do well in bad times as well as good times. No matter how bad the economy is at a given time, companies that make products that are essential to everyday life will survive. Okay, so these consumer staples, like you said, it's pretty safe, we would say, in an economy. You know, companies that, you know, essential things for humanity, you know, such as petrol, for example, would be a defensive portfolio. If you have shares of stocks that has petroleum, for example, would technically be essential to society, unless that changes in the future, you know, because we all know that the electric cars are coming as well, and that could impact in the future. But it's just for now. Like, for example, electricity companies would have a high impact in your portfolio as well, because it is essential. We all need electricity for everything, you know, for our internet, for our phones, for our computers, for our day-to-day life things that we do. For the most part, we need electricity, so it is focused on this. So another one would be income-focused equities portfolio. This type of portfolio makes money from dividend-paying stocks or other types of distributions to stakeholders. Some of the stocks in the income portfolio could also fit in the defensive portfolio, but here they are selected primarily for their higher yields. An income portfolio should generate positive cash flow. Real estate investment trusts or REITs are examples of income producing investments. Okay, so dividend paying stocks are good as well because it generates cash flow, and it's one of the things that I defend a lot, especially if you're starting. If you want to make money with stocks, passive income with stocks, or any investments in general, any types of investments in general, you need to make sure that you have cash flow. So you have your cash flow and working capital, because you could have, let's say you have $1 million in your bank account, but you're not generating any cash flow like monthly or every other month or stuff like that. If you're not really generating cash flow and you're stuck in a position, say you have an asset, you have a share of a stock of a company or something like this, and have $1 million there, but you're not generating anything. You only earn money when the stock goes up or down or whatever, when it fluctuates, and you're not generating dividends, for example. I'm not saying it's bad or wrong, it really depends on the strategy. But for example, in the scenario of say you bought, I don't know, maybe Tesla, and then Tesla's down like 10-20%, and you don't have dividends earning from that, for example, and you fully depend on this, you're totally relying on this to pay your bills and whatever, and you're not generating any dividends or any cash flow for like a whole year until the stocks go up, for example, then what happened is, even though you have all this money, that's not doing anything to you. On the worst case scenario. Of course, on the good scenario, it would change completely, because you would have made much more money. But on the worst scenario, you're not generating any income, and it's really bad. So you really have to be focused on this as well. And I'm saying all these things just so you know, and how you can like strategize your position, and how are you gonna approach building your portfolio, so in the future you can make a living out of it, or at least an extra income with not just your wage, the payment that you receive from your current work, but also off your investments as well. So it could be an extra income for you. And there's also a speculative equities focused portfolio. So a speculative portfolio is best for investors who have a high level of tolerance for risks. And I said that in the beginning of the video. Speculative plays could include initial public offerings, so the IPOs, or stocks that are rumored to be takeover targets. For example, AI. For example, I'm not saying to invest in AI companies. It's just an example for the video, okay? Technology or healthcare firms in the process of developing a single breakthrough product also will fall into this category. So speculative, okay? Speculative is high risk, but also high return, okay? For people who are, again, like I said, high risk tolerant, or stuff like that. But you need to be careful with everything, okay? It really comes down for you to make reevaluating your life. How old are you are now? What is your current position in life? Are you what type of work do you have? How much money can you generate in a month and in a year? How much of this money that you can generate, how much money can actually save and invest through the months and throughout the years? What is your focus? Do you want to make more dividends? Do you want to be speculative? Do you want to risk more or risk less? Do you want to be conservative? Are you trying to invest in stocks for your retirement plan? So you're not really trying to make more money, but you're trying to be safer? Or are you the type of person that's more into the treasury bonds and liquidity rather than fluctuation in stocks like this and losing all of your money? It really comes down to this. But it's good for you to start studying now. So the earlier you start to study, the better for you. It's all about becoming financially literate, and we are all here to learn. I'm here to learn, you're here to learn, and the more you put yourself out there and try to really study what you want for your life, how you're going to generate income, not just passive income, but active and passive income, and what you truly want, then the better you get over time, okay? And it all comes down to this: is study about yourself, is study about what you want, study a little bit about economics as well if you want to be good at it. And chances are, in the future, if you really take care of your future now, chances are your future self will thank you for the decisions that you're taking today. Okay, so I hope this video was insightful. I hope you liked it. Again, I'm sorry about the English. I stutter a little bit. It's just not my native language. I always use that as an excuse to stutter, But if anything, I'm just going to keep on training, and the next videos are going to sound better and clearer for you guys so you can understand better. But other than that, I hope this video gave you a little bit of ideas on how you can approach your investments and grow as a human being financially and in other areas as well. So thank you so much for watching. Subscribe for more. I'll see you in the next one. Have a good one, guys. Bye.